when you look at the correlations of these things, neither gold nor bonds are negatively correlated to equities, but they're not fully correlated. And that's where the benefit comes from. So when we start putting together a portfolio, it's how these things behave together that matters. So this graph, familiar performance on the y-axis and volatility on the x-axis. We've shown here international equities and Australian equities. So international equities, slightly higher long-term growth. Clearly in the very short term, that gap is much bigger and less volatile than Australian equities. And that's largely because when global markets get crazy, investors flock to the US dollar, driving down the price of the Australian dollar. And so that cushions the volatility in your international equities. And that's partly why you don't want to hedge your global equities, that currency buffer. This works in any country where you've got a commodity currency. So Canadian investors, South African investors, Australian investors. It doesn't work quite the same way for US investors. So if you're consuming any US personal finance content on the internet, you've got to keep that in mind. So what you would think looking at this is if I mix these two, I should get a number somewhere in the middle. That would be the human brain's natural reaction to this graph. The truth is you actually end up with a return that's greater than either and a volatility that's less than either. And that's sort of counterintuitive. And that's because these do move slightly independently. They're not perfectly correlated. So by mixing some Australian equities and some global equities, in this case 50-50, you end up with a portfolio that outperformed either at lower volatility than either. And that's a winning move when it comes to investing. You want to be moving up and to the left on this graph. And that's why I get extremely frustrated when I see internet commentary with people going, oh, Australian equities underperform global equities, therefore I should buy global equities. There's two flaws to that. One is this example where mixing the two gives you better than either. And secondly, that's been true in recent past, but it's not been true over the very long period. So since records began in 1900, Australia's actually outperformed the US. And whether that's true in the future is anybody's guess. The US has been, an extraordinary driver of global growth over certainly the past 20 years, despite its lost decade between 95 to 2005. But clearly, returns on equities are heavily driven by GDP growth, and the US has that in spades. But the point here is that mixing the few gives you a better return than either. So let's now plot some of the other asset classes on this graph. You've got your right up the top right-hand corner is small caps. So small companies should over the long term deliver higher returns than big companies. They tend to be more volatile and there tends to be much more opportunity for managers to add value. We've got gold up there in the top right, which is sort of odd a little bit. That's not what you would expect. You would say, well, gold is it's a defensive asset. It's a volatile reliever. It's a smoother in my portfolio. And yet looked at individually, it's got higher returns and higher volatility over the last 20 years than Australian equities. Not one that people would intuitively pick. Infrastructure, they're sitting just below international equities. That's again a good smoother. But the important point with these is that you shouldn't be looking at these individually. You need to look at how they behave together. And the Life Sherpa high growth, that's a 90% portfolio, performed a 50-50 Australian international equities at lower volatility over the past 20 years. Now, that's not to say that all 90-10 portfolios will outperform. And it contains a lot of stuff that has a lower return than the 50-50 international equities portfolio. Yeah, it's got some infrastructure in it, it's got some real estate in it, it's got some gold in it, it's got some small cap in it. But when you put all that together, taking into account these correlations, you actually end up with a better return. So both a higher return and a lower volatility. And this is the key nuance that's missing in much of that internet rhetoric. And then just showing an example, well, if you add a bit of bonds to that portfolio, you move to the left. So lower volatility, lower returns. And you pick up a greater decline in volatility than you lose in returns. Absolutely, you're going to have a lower expected return in your 80 growth portfolio compared to your 190 high growth portfolio. And as you add more and more defensive, you drop off the return. And that's fine, because that's how you align a portfolio with your own risk preferences and your risk horizon. So what does this all mean in practice for your portfolio? Well, really, lower volatility leads to lower variability in your future outcome. It makes it easier to stay the course, and it gives you a greater probability of achieving goals. And this is especially true when it comes to retirement income. So if you seek to get a higher expected return, but you take on a proportionally larger increase in volatility, your safe withdrawal rate in a retirement case will actually fall. And that's counterintuitive, but the maths is clear.